Welcome to the Score podcast.
Let's be honest, 2023 was a tough year for the consumer credit industry. New account originations, down. Delinquencies, up. Not much to cheer about. Or is there? I'm Jeff Richardson, and welcome to another episode of the Score podcast. According to the Federal Reserve Bank of New York, consumers opened approximately 912 million credit accounts last year, which is actually an 8% decline from 2022. The mortgage market was particularly slow. According to Freddie Mac, the mortgage origination market declined 30% last year compared to 2022. I recently attended a mortgage industry conference, and the sentiment was actually rather upbeat. The feeling is that there's nowhere to go when you've hit rock bottom, especially if interest rates are lowered and inflation declines. Well, those are big ifs, and I'm pleased to be joined today by a person who tracks these things and the companies that are affected. Joining me today is Kelsey Zhu. Kelsey is the lead analyst at Bernstein Autonomous, covering financial information services company. She started her career at Deutsche Bank's Shanghai office, covering China's cement and oilfield services, where her team was ranked number 1 in the All Asia Institutional Investor Survey in 2014. In 2015, she joined Bernstein's Hong Kong office as a research associate on the Asia IT hardware team. Over the last 7 years, her research experience has spanned across IT hardware supply chain companies that specialize in flat panel display glass PCs, and industry robotics, Asian equity strategy, as well as Asian and U.S. gaming companies. And then in 2018, she relocated to Bernstein's New York office to lead the expansion of Bernstein's global gaming team. And these days, at least over the past few years, she's built a team and a product that covers financial information services companies, which is why we're speaking with her today. Kelsey holds a BA in Business Administration from Hong Kong University of Science and Technology, where she graduated, wait for it, in the top 1% of her class. Kelsey, thank you so much for joining the Score podcast today.
Thank you so much for having me today. It's a pleasure.
So we talk about the credit markets quite a bit, as you can imagine, on this podcast, but would love to get your estimation. Kind of where are we in the current consumer credit cycle, and what's your rationale why?
I think we are basically at the trough, if not near the trough, at this moment in the current consumer credit cycle. I think this is pretty much in line with all the consumer credit companies we follow and their latest commentaries during Q4 results conference call. So we published our 2024 Outlook note earlier in the year, and the main message there is we're very close to seeing that positive inflection point, which we expect to occur sometime in the second half of the year. So we have several rate cuts coming in the US, and even in other key emerging markets that we track, like India and Brazil, we're also seeing rate cuts coming, which we believe will drive a mortgage market recovery and make consumer credit more affordable. Stable unemployment rates, which is basically the number one driver for consumer credit growth. And if you share our macro view, which is we'll go into a soft landing and see macro recovery in the second half of the year, we'll also likely see improvement in hiring activities, which will support growth for products like income employment verification, which is a big driver for certain companies under our coverage, like Equifax. So one key debate on consumer credit cycle that keeps coming up is how healthy are the US consumers currently? We're seeing delinquency rates exceeding 2019 levels for the fintechs, for bank card and auto, delinquency rates kind of going back to 2019 levels for private label credit cards. However, if we really dig into the numbers, we find that subprime as a percentage of total origination remain at a pretty healthy level for card and auto originations, and has actually been declining over time for fintech originations as well. On top of that, we're estimating that the US consumers still have about $400 to $500 billion excess savings. So the debt to income ratio remains pretty low compared to historical levels, and that payments as a percentage of disposable income remains at a healthy level. So overall, we see US consumers as a whole being pretty healthy, and we do expect consumer credit to recover in the second half of 2024.
That's optimistic, and we like optimistic here on the Score podcast. So I want to shift gears a little bit on some of the observations you've got on the market. Where do you see the innovation coming from when it comes to consumer data and analytics?
I think one big topic of innovation is really the usage of alternative data. So I remember when I first moved to the US, it was very difficult to get credit. I didn't have a credit score, I had no credit history. So I was one of those, classic thin file consumers. But at the time, I was employed by Bernstein Autonomous, which meant that I actually had a job with stable cash flow. But that didn't matter when I was applying for new credit cards, which was honestly a little shocking to me. So I'm personally a big supporter of the usage of alternative data. And this includes, kind of looking at people's rent payment, utilities payment, phone bills. And I think the latest development in alternative data is the usage of cash flow analysis, which takes into consideration of how much money you're making, how much day-to-day expenses you have, and really look at consumers from a much more holistic view. So some of the fintech players like Plaid and Finicity have products that facilitate this cash flow analysis, which I find very interesting. And there are a lot of consumer credit startups out there that help you build up your credit using kind of your day-to-day rent utilities, phone bill payments. And amongst the credit bureaus we cover, Equifax has also incorporated telco, utilities, pay TV data into their mortgage credit files. I thought it's also important to mention the usage of consumer consent data, which is another key innovation. And we have seen an increasing amount of startups coming into this space in the last year or two. Especially in income employment verification, there's a rising number of fintech players that will ask for consumer consent to have access to their payroll account or checking account data to verify that, for example, Kelsey indeed works at Bernstein Autonomous and actually makes enough money to cover this mortgage payment.
Yeah, we observe the same innovation as well. And certainly kind of consumer empowerment is a big trend looking ahead. This is a kind of a related question, I suppose. But as you know, over the past few years, credit scores have basically become ubiquitous, with most banks and many large fintechs actually providing credit scores for free to consumers to help them improve their credit health and monitor it. And by and large, it's worked. They have. So what other consumer credit tools have you seen come to market that have promise?
On this topic, I think it's probably worth discussing the usage of machine learning and AI. And I think a few years ago, it's probably unimaginable that we will be using AI to make credit underwriting decisions. But I think today, every major lender in America is experimenting how to utilize the power of AI. The main concern here is really the regulatory aspect. So how do you explain to the regulators and, more importantly, consumers how the model works exactly? Because when you use machine learning and AI to make underwriting decisions, sometimes we don't see the recipe behind how actual decisions were made. So how do we explain to a consumer, why he or she is rejected for a loan? And how do we prove that the AI model we built does not discriminate based on age, race, gender, and other protected data points? I do think AI and machine learning are here to stay. I think for now, maybe lenders are more focused on improving existing models' efficiencies and try to use these innovative tools to find their new cohorts of consumers they can market to. But in the future, we could see AI machine learning play a much bigger role in credit underwriting once we kind of figure out a way to prove that the models don't discriminate, or once we figure out how to maybe combine the power of traditional credit analysis with AI and machine learning.
So financial inclusion and maybe more specifically ESG, environmental social governance, those were key messages for consumer finance company CEOs, especially during the pandemic, on the heels of and during the Black Lives Matter movement. When you're listening to earnings calls, are you seeing any changes in messaging?
It's interesting that you mentioned ESG, as I also cover MSCI here at Autonomous, and ESG is a key growth driver for MSCI. And I think across the board, what was really interesting to me that happened in the last 2 years is that there's actually this rising anti-ESG sentiment in certain states in the US. And one of our research reports actually summarized all the outstanding anti-ESG bills and statements. If we really dive into a lot of these statements or regulations, a lot of them just want to make sure that asset managers are not excluding a certain industry in their investment mandate just because it's not so-called ESG friendly. So there are only 6 states where we've seen kind of blanket anti-ESG sentiment, and that's Florida, Arizona, Idaho, North Dakota, Louisiana, and Indiana. So along with these bills, kind of comes prolonged sales cycle for any ESG data research analytics providers, which also brings questions around the total addressable market for ESG products and services in the US. But as MSCI CEO Henry has recently commented on this in their Q4 results call, we won't be commenting on US politics, and we just kind of have to see what happens. So that's what's happening with ESG. On financial inclusion, consumer finance companies are still very committed to improving financial inclusion. And I think this kind of goes back to everything we have talked about so far, which is utilizing alternative data and utilizing AI and machine learning for credit modeling or pre-qualification and marketing purposes. And I think it is actually to the benefit for these consumer finance companies to expand their total addressable market, which will also help with financial inclusion.
Yeah, I totally agree. And undoubtedly, that's why we're seeing growth in the use of VantageScore. Last question for you, kind of a high-level question. We touched on this at the top, but how do you see some of the various consumer finance sectors performing this year? And then if you would pick out one area that might outperform, what would it be?
For mortgage, a lot of investors are expecting a significant rebound and recovery driven by rate cuts. On that note, we're actually only forecasting 9% growth in mortgage originations in 2024. And this is mainly driven by recoveries in purchase applications in the second half of the year. We believe mortgage rates need to fall significantly to drive meaningful refi volumes. So if we look at the latest ICE data, mortgage loans seasoned between 2 and 10 years tend to have rates lower than 5%. Even if we look at the 2022 to August 2023 cohorts, it looks like loans originated are evenly distributed across from mid-threes to high-6 mortgage rates. And by the end of August 2023, there are only 600,000 loans that have interest rate at or above 7%. And there are only 1.9 million loans that have interest rates between 6 and 7%. So rates need to come down to the 5% range to make this refi possible. I think in credit cards, historically, we see a very high correlation between card origination volume and growth in marketing spend by major card lenders. So after an aggressive growth in card marketing spend post-COVID, in 2023, we actually saw a modest pullback from card lenders. However, in 2024 and 2025, we'll likely see growth pick up again. So the street is forecasting 8% growth in card marketing spend in 2024 and 2025. And that's the basis of our card origination volume forecast. In auto, we're forecasting 5% growth in auto originations in 2024. And this is helped by some of the recent declines we've seen in used car prices, stabilization of new car prices, and we do expect continued resolution and improvement of pandemic-related supply chain issues. Over the last decade, auto origination has grown by 6% CAGR. And in 2024, we're expecting auto origination growth to revert back to close to its historical average level. Talking about sectors that will outperform, we find that the fintechs are a key area to watch. So in our analysis, we find that fintech originations and delinquency rates are particularly sensitive to rates and macro conditions. So the higher rates in the last 18 months have led to lower origination volumes and higher delinquency rates. However, with rate cuts coming in 2024 and 2025, we expect fintech originations to revert back to that double-digit growth we've seen in the last few years.
Sounds like another optimistic guidance from you. Again, we love that here. Kelsey, this was super informative. Thank you so much for your time and insights, and we can't wait to have you back.
Thanks for having me. Really appreciate the opportunity to have this conversation.
Optimism has no obligation to provide any updates or changes at any time in the future. All references and/or market forecasts are correct as of the date of recording. The views and opinions expressed in this podcast are those of the presenter and may not be the same as the views of Optimism or its affiliates. Optimism is not providing any financial, legal, or tax advice or investment recommendations in this podcast, and this should not be construed as investment advice. This podcast must not be copied, distributed, published, or reproduced, in whole or in part. While parts of the credit origination market struggled, overall, the economy did quite well last year. As listeners know through our Credit Gauge insights, there are segments of consumers that struggled and continue to struggle. But overall, consumers have been incredibly resilient through the pandemic and after. For VantageScore, we're optimistic, just like Kelsey is, about our growth. We see adoption of our scores surging across product lines, and with the requirement that GSE mortgages utilize VantageScore 4.0, we expect gaining even more traction amongst the largest users of credit scores this year. For those details, you'll have to wait, but I promise you, we'll have news to share in the coming weeks. I'm Jeff Richardson, and I look forward to our next conversation.
The views and opinions expressed in this episode do not necessarily reflect the official policy or position of VantageScore Solutions. Visit VantageScore.com to learn more.